I have a little extra money. Is it smarter to make extra principal mortgage payments or add it to my 401k? So I get asked this question a lot, and there's really kind of two ways to think about it. There's the purely financial, mathematical way, and then there's kind of the psychological way. Now, the purely mathematical way would say, okay, what is the interest rate on your current mortgage? If you locked in your mortgage within like the last couple of years, you are locked in at all-time historic low interest rates, which means that you can put extra money to work almost anywhere else and earn a greater return than that. Like, just for perspective, some people were able to lock in mortgage rates below 3% in the last couple of years, which means that right now they could just put cash in a high yield savings account that generates more money than what it is costing them to have their mortgage outstanding. So that's kind of the way to evaluate when you're looking at anytime you have kind of a this or that financial scenario. Look at, okay, what is the interest rate on this? What is the potential opportunity cost, or what could I earn putting that money somewhere else? And the decision you make should be based on the higher number. So if I had a mortgage that was costing me, call it 10% in interest, it would be a no-brainer to say pay down that mortgage. But the reality is that you can put money and invest it, and on average over the long run, depending on kind of your risk preferences, you're gonna earn somewhere around 7 or 8%. If you put it all into the stock market, it might even be closer to 10%. And your mortgage right now is likely only costing you 2.5%, 3.5%, 4%. Now, if you have a second mortgage, for example, that is at a higher interest rate, if you are currently paying PMI because you didn't put enough of a down payment down, those are higher costs that can be worth putting that money towards your mortgage to eliminate those and bring down that monthly interest cost on your mortgage. But otherwise, financially speaking, you're better off putting that money to work somewhere else. Now, what is the psychological piece of this? The other way that people sometimes think about this decision, particularly if they're looking at retiring early, is if you can eliminate your mortgage, it eliminates most people's monthly largest expense. If you eliminate kind of your monthly run rate, your monthly cost of living, that reduces the passive income that you need to generate in retirement. So that means you need to have less set aside for retirement to generate an earning stream to live off of, and paying off your mortgage can help kind of accelerate that process. That's kind of the flip side. But mathematically, financially speaking, typically you're going to be better off putting that money to work, earning higher interest somewhere else. So I hope that helps.